It's 11:38 p.m., and Luis is back at the machine shop, opening the bottom drawer where old prototype receipts have been sleeping since 2022. He is not looking for nostalgia. He is looking for cash flow, because a tax rule changed and those experiments may deserve another look. Here's the signal. New Section 174A generally restores immediate expensing for domestic research or experimental costs in tax years beginning after 2024. That matters because from 2022 through 2024, many domestic R&E costs had to be capitalized and amortized instead of deducted right away. And software development still counts as R&E under these rules, which pulls in custom apps, internal tools, customer portals, and product code. So this is not only a lab code episode. It is for machine shops, food brands, agencies, software teams, and product founders with messy project folders. Luis spent $31,000 on fixtures, CAD help, and failed material runs for a part that finally reduced scrap on a customer order. Pause. At the time, his CPA said the deduction had to stretch over years. Luis heard one thing: less breathing room this quarter. Guidance summaries say eligible small business taxpayers may have a limited path to apply Section 174A retroactively to years beginning after 2021. That word eligible is doing real work. This is not financial advice. Before amending, consider whether your business meets small business rules and documentation tests. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor or business consultant before making significant financial decisions. Now back to Luis. His drawer has supplier invoices, contractor bills, and a notebook full of test settings nobody wanted to organize. Your version may be a folder in Google Drive, a QuickBooks class, a GitHub repo, or a plastic bin under the shipping table. The first move is not filing, it is inventory. Pull 2022, 2023, 2023, 2024, and 2025 projects that involved uncertainty. Businesses with previously capitalized domestic research costs may be able to keep amortizing, accelerate remaining amounts, or spread recovery over 2 tax years. That choice can affect taxable income, loans, owner draws, and next year's planning. Bigger deduction timing may help, but only after modeling. Luis had one project called the Quiet Clamp. It was supposed to cut vibration on a small production run for a regional customer. The first clamp warped. The second scratched the part. The third worked, but only after a contractor changed the angle and material. That story matters. R&D documentation is often the trail of what failed, what changed, and why the answer was not obvious. Start a project list with 4 columns: what you tried, what uncertainty existed, who worked on it, and where the work happened. Foreign R&E costs generally still must be capitalized and amortized over 15 years, so domestic and foreign work need clean separation. That separation catches founders off guard. A local founder, an offshore developer, and a stateside contractor may sit inside one product build. Tag the location of labor, contractors, and testing. If you use overseas development help, ask your preparer how those costs should be treated. For a software shop, the receipt drawer may look invisible. Payroll, cloud environments, repositories, contractor invoices, and sprint notes carry the story. Thomson Reuters notes software development costs continue to fall under the R&E framework, making Section 174A relevant beyond classic product research. So do not let the word research scare you. Building a custom quoting tool can be more relevant than buying a microscope. Maya runs a small agency. In 2023, her team built an internal workflow tool because every client approval was disappearing into email. Small laugh. It was not glamorous. It was a half-broken dashboard, a contractor, and months of Monday morning complaints turning into requirements. That may be worth reviewing. Not every software cost qualifies, but development meant to solve technical uncertainty belongs in the conversation. Ask your tax pro to separate maintenance from development. Bug fixes, routine updates, and experiments should not all land in one bucket. Grant Thornton describes Section 174A as permanently allowing full expensing for domestic R&E paid or incurred in taxable years beginning after 2024. Permanent does not mean simple. Tax rules still ask when costs were paid, where work happened, and which election fits your return. If you are cash tight, immediate expensing may feel obvious. Still, consider net operating losses, lender covenanters, and the timing of owner income. RSM summarizes procedures for acceleration elections, including recovering remaining unamortized domestic R&E amounts in the first eligible year or over 2 years. Food founders, this touches you too. A shelf-stable sauce, a new packaging process, or a formulation experiment can create reviewable costs. Picture Anna's salsa brand. She paid a food scientist, bought test batches, changed acidity levels, and tossed jars that never reached a shelf. For a food project, gather lab invoices, ingredient purchase records, batch notes, consultant emails, and evidence of what question you were trying to answer. Do not oversell it. Your CPA needs facts, not a heroic founder story. The more boring the proof, the better. Product businesses have their own drawer, molds, samples, failed packaging, CAD revisions, usability testing, and small production runs that taught expensive lessons. Create a one-page project memo now while memories still exist. Name the goal, uncertainty, tests, people, vendors, and outcome. The IRS says OBBA added many tax provisions, including research-related changes, with further guidance and procedures released after the law was enacted. That means your preparer may still be digesting procedure. Bring organized questions, not a shoebox and a hope. Question 1. Do we qualify as an eligible small business taxpayer for retroactive Section 174A treatment on 2022 through 2024 domestic work? Question 2. Should we amend returns, file a method change, or leave prior treatment alone because the math is better that way? EI summary highlights amended return and method change procedures, with July 6, 2026 timing considerations for certain small business elections. Put that date on your planning radar, but do not sprint blindly. Your filing history and extension status can change the route. Question 3. How does this interact with R&D credits, state taxes, interest limits, and any net operating losses we already created? This is where founders get annoyed because the rule change sounds like found money, and then the spreadsheet grows tentacles. Tax hail? I get it. But tax timing is still timing. A deduction in the wrong year may be less useful than it looks. Advisors have noted the change may simplify compliance and improve cash flow for many businesses, but outcomes vary by facts and timing. If your accountant gives one answer instantly, ask for the model. You want side-by-side scenarios, not just a confident shrug. A simple model compares taxable income before the change, deduction timing, refunds, state impact, cash received, and next year consequences. For Luis, the model showed a possible refund mattered, but preserving clean books for bank underwriting mattered too. He wanted a new lathe. The bank cared about profit trends. The tax answer had to live beside the financing answer. That is small business reality. The smartest tax move may not be the cleanest cash flow move once lenders, partners, and payroll enter. RSM notes taxpayers can choose different recovery approaches for remaining domestic research amounts, so the decision is not one size fits all. Make a file named R&D Review, then create folders by year and project. Keep source documents untouched, and add a plain English summary. For payroll-heavy businesses, estimate time by project from timesheets, calendars, tickets, commits, or manager notes. Avoid guessing when records can support you. E-notes foreign research costs remain subject to 15-year amortization, which makes contractor location and cost coding especially important. If you do not know where a contractor performed the work, ask now. Future invoices should show location clearly before tax season pressure hits. Agencies should review custom automation, reporting tools, and workflow software. Manufacturers should review prototypes, tooling trials, and process improvements. Food brands should review formulations and packaging tests. Retailers should review custom inventory or ordering systems. Software shops should review feature development and platform rebuilds. Build a maybe list. You are not deciding qualification today. You are giving your tax pro a clean map to investigate. If this episode helps you ask sharper CPA questions, follow the show. We are trying to make the useful signals easier to find. One more guardrail. Ask your CPA whether expense timing and any R&D credit studies should be handled together or separately for planning. Ask whether claiming or adjusting one affects the other. Many businesses find the paperwork overlaps, but the calculations can diverge. Before your next tax meeting, send the project list early. Give your preparer time to think, not just survive deadline week. Lewis finally stopped treating the drawer like clutter. It became a map of experiments his business had already paid for. Hoffly, some of those experiments failed. Some saved customers. Some may change a tax return. All of them tell you how the business learns. The point is not to chase every possible deduction. The point is to stop ignoring work that tax law may now treat differently. This week, poll the projects, sort domestic from foreign, mark software development, and book a focused tax planning call. Bring curiosity, not certainty. Your numbers will decide the move, and a qualified professional should pressure test the timing. That receipt drawer is not just history. It may be a planning tool for building a steadier, better documented business.